All right, let's dive into one of the biggest, most persistent puzzles in all of economics. It's this tricky relationship between inflation and unemployment, a genuine dilemma that policymakers, central bankers, and really all of us have to grapple with. It's not just theory, it directly impacts our jobs and the prices we pay every day. So let's just cut right to the chase. Here's the big question. Does a country have to pick its poison? I mean, can we have it all? Stable prices, so our money is worth something, and lots of jobs, so everyone who wants to work can. Or are we stuck making a really painful choice between the two? This is the fundamental trade-off we're going to unpack today. For a little while, it really seemed like economists had cracked the code. They came up with an idea that was so simple and elegant, it was almost like a menu for running an economy. Policymakers could just look at it and, well, choose the outcome they preferred. Let's take a look at this powerful and very tempting idea. And this so-called menu got a name, the Phillips curve. Back in the late 1950s, an economist named A.W. Phillips noticed this pattern, and it suggested a simple, powerful idea, that there's this predictable inverse relationship between inflation and unemployment. When one goes up, the other goes down. And the logic behind it is pretty intuitive, right? Imagine the government or the central bank steps on the gas to boost the economy. That means more overall demand for stuff. To make all that stuff, companies have to hire more people, so unemployment goes down. Great. But with more money chasing the same amount of goods, what happens? Prices get pushed up, and boom, you get inflation. It's a direct and seemingly simple trade-off. And here's the thing, for a whole decade, the data seemed to back this up perfectly. If you look at the US economy in the 1960s, the numbers line up beautifully on this downward-sloping curve. It gave policymakers this incredible sense of confidence. They thought, okay, we can handle this. We can choose a point on the curve. Want less unemployment? Fine, we'll just accept a tiny bit more inflation. It seemed almost too easy. But then, just when everyone thought they had the economy all figured out, the story takes a really dramatic turn. This simple, elegant theory, it was about to collide head-on with a very messy reality. And that messy reality was the 1970s. Suddenly, the data just went haywire. That nice predictable curve from the 60s? Poof, it was gone, replaced by this chaotic mess of dots all over the place. The relationship completely shattered, and it left economists just scratching their heads, asking, what on earth just happened? The problem was a new kind of economic beast that nobody was prepared for. It was called stagflation, and it was literally the worst of both worlds. The economy was stagnating, which means unemployment was high and getting higher, and at the same time, inflation was also high and getting higher. This was supposed to be impossible. The Phillips curve said these two things should always move in opposite directions. So, what was the culprit? It was something the original theory had kind of forgotten to account for, a supply shock. The classic example, of course, is the OPEC oil embargo in the 70s. All of a sudden, the price of energy, a critical input for almost every business, just skyrocketed. This forced companies to raise their prices and lay off workers. That combination is what created stagflation and broke the old model. Now, this crisis forced a total rethink of the whole theory. But what's fascinating is that a couple of economists, Milton Friedman and Edmund Phelps, had basically predicted this would happen. They argued there was a giant missing piece to the puzzle, and that piece was all about what's going on inside our heads, our expectations. Friedman and Phelps introduced this absolutely critical distinction. We have to think about the short run versus the long run. They said, sure, in the short run, for a little while, that trade-off might exist. You can get a temporary win. But in the long run? Nope, the trade-off completely vanishes. They argued that unemployment will always eventually drift back to its natural rate, no matter how high you push inflation. And this idea is called the natural rate hypothesis. Think of the natural rate as just the economy's baseline level of unemployment. It's the rate we settle at when all is said and done. Sure, policy can create a temporary dip below that rate, but it can't hold it there forever. The economy eventually adjusts. And the mechanism that makes this happen, the secret ingredient, is expected inflation. It's not just about what inflation is today, it's about what we all think it's going to be tomorrow. If everyone starts expecting, say, 5% inflation, guess what? People start demanding 5% raises, and businesses start pricing that in. It becomes a self-fulfilling prophecy that actually moves the entire Phillips curve. Okay, so here's how it works in practice. Picture this. The economy is just humming along at its natural rate of unemployment. Then, the central bank decides to create some surprise inflation to try and get unemployment down. And for a little while, it works. But pretty soon, people aren't surprised anymore. They catch on. They start expecting higher inflation, and as their expectations adjust, the short-run trade-off disappears. The curve shifts up, and unemployment goes right back to where it started. The only difference is, now we're stuck with higher inflation. The magic is over.
This new, smarter understanding of how things work comes with a very serious and often very painful implication. Once high inflation gets baked into people's expectations, getting rid of it isn't simple or free. In fact, it comes at a tremendous cost. The process of bringing the rate of inflation back down is called disinflation. And to pull it off, a central bank has to do the exact opposite of what caused the problem. They have to slam on the brakes, pursuing contractionary policy to slow the economy down. And what does that mean in the short run? Well, it means unemployment is going to go up. There's no way around it.
Economists have a pretty grim name for this painful process, this sacrifice ratio. It's a measurement of just how much economic output, how many jobs, how much growth we have to give up, or sacrifice, to bring inflation down by just a single percentage point. And the number is, well, it's sobering. A typical estimate is that to reduce inflation by just 1%, a country has to be willing to sacrifice 5% of its entire annual output for a year. That's a huge number. We're talking about real businesses shutting down and real people losing their jobs. And listen, this is not just some abstract theory. We saw it happen in the real world. In 1979, inflation in the U.S. was out of control, over 10%. The new Federal Reserve Chair, Paul Volcker, decided enough was enough. He deliberately put the economy into a deep recession. It was brutal. By 1983, unemployment shot up to almost 10%. But it worked. Inflation was crushed, falling to around 4%. The theory was proven right, but the sacrifice was immense. So, with all that history as a backdrop, how does this help us understand the crazy economic shocks we've been living through in the 21st century? Let's bring this whole story right up to the present day. In the past couple of decades, we've really seen it all. The Great Recession back in '08 was a classic demand shock. Demand just collapsed, which sent unemployment soaring while inflation actually went down. But the COVID-19 pandemic, whoa, that was a whole different animal. It was a chaotic mess of everything at once, supply chains breaking down, and a fire hose of government stimulus money. And this brings us to the huge debate that raged recently. In late 2021, when prices started to spike, you had one group of top economists arguing, hey, calm down, this is temporary. They believed it was all caused by those supply chain problems from the pandemic and that eventually things would just sort themselves out. But at the exact same time, another group of economists from the very same expert panel were sounding the alarm. They warned that all the government stimulus was the real problem and that it was creating a serious risk of long-lasting inflation. It just goes to show, even with all this history, these are still incredibly tough calls to make. Which leaves us right back where we started, with the ultimate economic question. After all this, from the simple curve of the 60s, to the pain of the 70s, to the confusion of the 2020s, is there some kind of magic policy out there? Is there a way to fix high inflation and high unemployment at the same time without any pain? Well, if the story of the Phillips curve teaches us anything, it's that in economics, there are no easy answers. There are no magic bullets. There's only a constant, difficult balancing act.